Okay, today I'm joined by Paul Schultz. Paul is CEO of Aon Securities, and his team are highly prolific in the areas of catastrophe bonds, arrangements of sidecars, other collateralized reinsurance vehicles, as well as other areas of investment banking for the insurance and reinsurance world. And as part of the broader Aon group, they have significant resources at their disposal. So I felt it would be interesting to speak with Paul, see how things are going for him in this challenging and uncertain time, and find out how he's viewing the market's status at this point in time. So Paul, thank you.
Yeah, pleasure to be here. Thanks for the invitation, Steve.
Sure. So let's start off with something fairly basic. Let's talk about the ILS market, as that's our target audience here. And how do you see the market adapting to this new, different world that we find ourselves forced into at this point in time?
Yeah, so great question. And I guess the first thing I'd say is kind of hoping everybody out there is safe, stay home. And we have our mayor in Chicago actually on commercials singing to us, with a guitar saying, "Stay home, be safe." And so I'll say the same to kind of all of you. Um, I would say it feels in some sense like pre-COVID was years ago, and in another sense it was kind of minutes ago. So I think we've all been kind of adapting to kind of what the new is, and how we go about things we do. Generally, I would say that this industry has shown resilience in times of crisis, and I think this is no different. And so um, I think the industry is well connected. I think all the right topics, all the right conversations are being discussed at the time. I think people are reachable. People are doing business today, and so I think both from a cedent perspective and from an investor perspective, I think everyone's being constructive in a period of great dislocation and uncertainty. So again, I think this industry has proven itself in other times of crisis, and resilience is a word that we'll use quite a bit because I think the industry has shown resiliency.
Sure. Yeah. No, I find it quite amazing how this industry adapts so quickly as well when different things are thrown in its direction. Because this is an industry that, to an outsider, might look like one that is constantly on the road, traveling around the world, meeting clients and things, and then suddenly they're thrown into their own homes, and actually business carries on very quickly as usual, which
Yeah.
I find quite impressive. So you haven't seen any sort of operational issues emerging or market-facing issues at all?
No, none really. And what I would say is, technology has proven itself in spades, really, throughout this. And so, we're connecting. Most of the calls we're doing these days are video, and so we're connecting as personally as we can, either with colleagues or with clients. And I think the technology has enabled us to perform at a high level still. We are kind of entertaining how we get back to work at some point whenever we're allowed and whenever it's safe. And I think even then we're kind of just trying to figure out what is essential that needs to be done inside of an office versus can be done from distance. And it's really hard to make that a long list. Obviously, there's a few things that make life easier to be inside of an office with a lot of infrastructure and resource. But practically speaking, I think we can work from a distance and be as effective.
Sure. Yeah, I think this is something that's going to change the entire world of work. Gives people a chance to reflect on what was really important, I guess, in their operations, and what may not be quite so essential as they maybe once deemed it. So more broadly, outside of the ILS world, I mean, obviously you guys speak to reinsurance and insurance companies as well as cedents. Are you seeing any issues there at all, or is it pretty much business as usual across the board?
Yeah, I was going to use those words, and we always hesitate to use business as usual in a time of uncertainty and crisis. But I think, broadly speaking, we have just come through the April 1 renewals as a firm, as an industry. And I think, that, to the extent you can use those words, it was business as usual. now kind of our firm and the market's focused on the June 1, July 1 renewals, and that appears to be orderly. I would say that we're certainly working with clients and talking with clients broadly around capital positions and kind of the impact not only on the liability side but the asset side, and just making sure we fully appreciate kind of the state of the world and the state of our clients and state of our markets. But I would say, reinsurance generally is, performing quite well, actually. And I think a testament, reinsurance, I think, was one of the industries that really stood out in terms of performance around, the last major dislocation in the global financial crisis. I think reinsurance, again, is performing quite well. And what I would say is the connectivity, at least in our firm, and I'll just use kind of a few statistics, not only for Aon Reinsurance, but just across Aon. At any one point in time, we have 60% of our colleagues on WebEx and video. And when you look at some peak times, we have, kind of, I'll use a number like 80,000 kind of WebEx connections, and we have 50,000 employees. And so obviously there's a great amount of connectivity across our firm with clients and investors and markets and kind of all of the people we would normally talk to. So connectivity and communication, which is really critical at this time of uncertainty. I think people are stepping up. We're trying to be creative in the ways that we connect with our team, and whether that's virtual happy hours or virtual lunches or virtual dinners. I mean, we're doing everything we can to connect, and probably connecting in some sense, more as a team, as a group, as a firm, as as a collective, than we would in normal times when people are on airplanes and everywhere else.
Sure. No, that's great to hear. It really has been an impressive response, I think, industry-wide to this change. So let's move on to the cat bond market, which has obviously seen an interesting period this year, I guess, with a record first quarter, and then suddenly, when the awareness of the severity of the coronavirus and how it was spreading globally kicked in, obviously investors were very, very fast to move, some of them, and to request to sell out some fairly chunky sized portfolios of bonds, which the market reacted very positively to, and a lot of managers sort of picked them up, I guess. How's that been from your side, as you have a sort of trading desk within your unit as well as sort of primary issuance?
Yeah, so great, so a great backdrop here. And as you articulated, the first quarter was a strong quarter in terms of primary issuance. Probably less, happening in the secondary, but certainly from a primary perspective, good flow into the market. And then we kind of hit a wall, and then it was very much a point in time where the primary deals that were in the market closed. A good focus on kind of the secondary. A few of the participants, put out BWICs, put out bid lists, and I'd say the secondary market was again very orderly, and especially when you compare that to what's going on in the broader financial markets. And so, listen, I mean, for us to trade down 5-6 points, to provide liquidity when liquidity was needed. Compared to kind of the volatility we're seeing in other markets, I think the non-correlating nature of the performance of our asset class, has stood out, yet again. And by the way, everything in life is recalibrated so much faster these days, and so it's important that we continue to demonstrate that non-correlation. And I think the industry, again, in a time of crisis, has shown resiliency here. And I think the funds that needed liquidity were able to achieve liquidity in the secondary markets. Again, maybe trading down a point or two, in some cases a bit more. But I think the managers that had cash and were able to take advantage of buying something a point or two cheaper were able to do that on behalf of their client base, their investor base. And so again, I'd say come out of this pretty strong. Secondary market today is actually kind of a little bit more quiet, maybe not as quiet as the first quarter, but now that we're seeing kind of the primary issuance market reopen, I think the focus is rightfully so, kind of focused on that a bit more.
Yeah. No, I think that's been a very positive outcome as well, the way investors and managers have reacted to the needs of certain investors in terms of wanting liquidity, and where cat bonds are a very small piece of their portfolio, it's very useful for them to be able to cash those in at this point in time, and the market supported that. And then as soon as that initial rush of sales was through and the broader financial markets start to bounce back very quickly, now we have 3, 4 cat bonds being offered to investors again. So the pipeline really came back quite quickly this time, which was impressive to see.
Yeah, listen, I think, all things being equal, if we haven't been living this for the last, I guess a few months now, we would have seen greater primary issuance. And so there's no question that, the pause we've taken will sort of impact Q2 a bit. But I think largely, largely the primary issues are going to come to market, and largely we'll get, the deals done. And so I think that's all good. One of the it's kind of like a good and bad double-edged sword. I mean, the fact that we've held good value and close to really not trading off a lot, is that then for multi-strategy funds, it's tempting to sort of take some of that capital and reallocate into where others might see disproportional or opportunistic type of investment opportunities. So it's one of these things where we've proven it and it's good. And by the way, fundamentally, that's helpful to kind of all of the capital providers here. But it's also tempting to reach into that, piggy bank at times and take some capital out. And so, that's the double-edged sword that I think the managers are living. And as I say, managing that very well in this period of crisis.
Sure, yeah. So, I mean, from the cat bond market point of view, obviously you said possibly issuance will be down a little bit on where it could have been, but do you feel we'll see all of that issuance at some point this year?
So I think it's you can easily paint a scenario where some of the primary issuance might be delayed, or however you want to think about Q2 in some fashion, might be just taken up in traditional reinsurance markets. Mm-hmm. By the way, that is a complementary relationship between more conventional reinsurance and kind of the capital markets version of that. I think that has moved from a competitive kind of attention play between the two markets to now very complementary. So it's very easy for clients to move back and forth, and I think some of what might have happened might go back into traditional markets, which I think is great that the ultimate cedents are being served in a way that meets their risk transfer needs. But I think you can paint a picture as we go through the summer, as you get into autumn and fall, that we actually could make up what might have missed in Q2, and then even more so. So I think it's a very easy scenario to say that we could see heightened activity in the second half of 20 that wasn't anticipated, and so I still feel like the place of this market, to help clients kind of manage their risk transfer needs will be as great or even potentially greater than we contemplated at the beginning of the year.
Sure. And I guess there's the chance that we begin to see some fresh inflows as well once the broader financial market volatility has settled down a bit more and investors feel a bit more certain. ILS and cat bonds are certainly going to look like a good defensive asset class for those investors at this point in time.
Yeah, we just compared kind of the cumulative returns and kind of the relative performance of ILS, compared to other types of asset strategies. And I think, again, when you just look at the lack of volatility in a volatile time and still very attractive cumulative returns, I think there's very much an argument to be made for more capital to come in at this point in time. The reality is that we've gone through, where I think we still are a bit in a defensive mode, as you highlighted, where cash is important and liquid assets are important, and kind of all of those things which you kind of revert to in a time of crisis. At some point, and again, I think I'm very optimistic we will get through this. I mean, I don't know that we know how or when, but I think given the human spirit, we will get through this, and at some point in time, kind of things will start to come back to more normalcy or whatever the new normalcy is. But I think a very strong argument can be made that the fundamentals of why this asset class was created 20 plus years ago still are intact and maybe even more important from just just the characteristics of performance and the opportunities available going forward. And so I think those arguments will be made by managers and by everybody else, and I think should be pretty well received by the investment community.
Yeah, and that's without even considering the sort of the size of the industry loss that eventually the traditional market will face, and in terms of how that might push demand for protection as well, and new product solutions, which, as we know, the ILS market is very good at providing. So let's move on to sort of a more specific issue that's obviously a hot topic at the moment, is around business interruption claims in property towers and potentially some catastrophe programs, and how that could potentially fall into ILS funds or certain collateralized reinsurance structures such as sidecars. Do you have any view on that? Do you see this as a potentially large issue for the sector, or just something that's going to be on a case-by-case basis?
I think very much the latter. So I would say it's a very specific, case or client by client kind of basis here. So I mean, fundamentally, before everyone just jumps to kind of a broad brush kind of view on this, I think you have to look at the underlying contracts. And I know there's obviously some, we're all kind of watching the headlines of what's happening, in the U.S. We're kind of watching kind of what happens kind of outside the U.S. and just in terms of the way that courts, regulators, legislators, whoever kind of the constituents are here are kind of talking about some of these potential implications. And so we're all watching it. It's very hard to speculate on what's going to happen with that, and that will play its course out. It's important to kind of look at the fundamental or the underlying contracts that are underlying the reinsurance and the risk transfer that's being purchased here. And so for for personal lines exposure and for whether that be homeowners or motor or whatever, it's challenging to get to some of kind of the assumptions that we're hearing in the marketplace, just in terms of what could really happen there. For commercial and kind of other exposed businesses that might be subject to more scrutiny and more sort of political and regulatory pressure, a little bit more thought has to be given to that. But I think it's going to be, take a look at kind of what the underlying risk is, take a look at the strength of the wording and the contracts and things like that, kind of overlay whatever one's assumption might be for kind of the regulatory and political issues. At the end of the day, reinsurance insurance is intended to be kind of an event-based, protection, and largely defined by time. And so, kind of any way you want to come at this, could there be some exposure? Yes, I think there can be some exposure, but I think some of the more draconian views about what can happen, a lot would have to happen between now and then to be able to support some of those in the marketplace. But yeah, I think it's something where, the more traditional way of participating in this market, like cat bonds and things like that tend to be a little bit more remote and tend to be kind of just excess of loss. And I think it's going to be hard to imagine that that's going to be, impacted greatly. Some of the more ground up business, and whether that's, proportional, whether that's, sidecars, whether that's some of the retro business, could there be some implications? I think, possibly, but it's just awfully hard to speculate on sort of what that regulatory or what that political, fallout might be.
Sure. I mean, one of the things that I'm sort of spending a bit of time thinking about this week is how long potentially a tail for the coronavirus pandemic could become for anybody who is exposed to potential litigation risk for certain positions, particularly things like, I guess, quota shares and private sidecars, that sort of thing, and what that could mean in terms of having to potentially retain collateral over quite a long period of time.
Yeah, at the end of the day, for collateralized products, there's always a tension between, what is the right tail that provides the cedent's protection against future development and investors a return, and kind of what's that right balance. And I think as an industry, we're still trying to figure out kind of what that efficient point in time is. But yeah, I think there's always going to be that stress, or that striving to achieve a better balance for both parties on this. And so just look at that as any type of development on any type of cat, where the payout pattern isn't as quickly as you'd like to be able to pay out entirely within kind of the contract, and you have to take some view on kind of what future losses could be. And so I just put that into that same category, which is it just creates uncertainty around the final computation. But again, we're trying to figure out what's the most efficient way of tackling kind of that fundamental mismatch between what reinsurers and insurers promise to pay, which goes on continuously, and then the finite term of a security or financial type of contract.
Sure, great. Okay, so rather than take up too much of your time today, I thought I'd ask you. So, what's the immediate priorities for your team at Aon Securities? What are you spending time working on? Is it just trying to make sure clients are comfortable in all of their sort of meeting their needs in terms of protection at this point in time?
Yeah, so I mean, we're busy, I think, like everybody in the market today. So one is we're focused on execution, where we're in the market executing on behalf of clients, and so that will continue to be a priority here. Focused on building the pipeline, and I think as you probably can imagine, we're being pulled into a lot of things, a lot of types of discussions with clients, globally, as clients think about what the rest of the year could look like for them in terms of what they're going to buy in terms of risk transfer capacity. And so it's this balance between executing and having these conversations. And so I'd say all extremely constructive. Probably not enough time in the day. Again, like most folks in the business. So one of the advantages and disadvantages of working from home is you can start early and work late, and kind of never leave your desk. But I think all sort of very constructive here, and lots of conversations. And I think the team, again, we're connecting globally as a team in a way we haven't connected before. So a lot of video, and so connecting Tokyo and Dublin and New York and Chicago and London together. Which was more difficult, or by conference call wasn't as personal. I feel like the personal connection around the team is greater than it has been, and so the ability to share, and the ability to make sure that we know exactly how we're advising clients in Bermuda, or clients in Europe, or clients in Japan, as an example, kind of real time. I think lets us be a little bit more efficient, and lets us be a little bit more certain in a time when there's uncertainty. So we're really taking the approach of what is it that we know today, kind of what is it that we don't know, quite frankly, and then helping clients navigate that uncertainty of what we don't know. And that's really fundamentally, that's what all our colleagues are thinking about today, which is let's act on what we know, and let's be honest about what we don't know, and let's try and mitigate that uncertainty with our actions.
Sure, that's great to hear. So look, thank you very much for your time, Paul. I really appreciate it. It's been great to talk to you, and hopefully you and your family will continue to stay safe, and we'll talk again soon.
Okay, great, Steve. Happy to be here.